Hey, what's going on, everybody? My name is Sam Kwok, one half the Kwok Brothers, a certified credit counselor and real estate investor. And in this video, I'm going to show you how to pay off your mortgage in as early as 5 to 7 years without having to pay extra into the existing mortgage, without having to refinance to a lower rate, changing your income, or even hurting your credit. Ultimately, so that this can help you advance towards your investments or your retirement and truly being able to enjoy your life. Now, just take a look at this. This is a screenshot of one of my clients, Christy, who says in 4 months, she was able to pay off nearly $41,000 off her mortgage balance in just 4 months using the method and the strategy I want to share with you in this very video. Here's another one. This is Michael and Jamie, clients of mine, who in 1 month, using this method I'm sharing with you on this video, paid off $11,498 off their mortgage balance. So I want to show exactly how this method and strategy works, so definitely stick around. Now, before we continue, I do want to share this as a disclaimer, letting you know that I am not a tax and legal professional, so please make sure you consult with your professionals before you implement all or parts of this strategy. And also, definitely stick around to the very end of this video because I do have a personalized special gift waiting for you. Okay, so before we get to the strategy itself, I know many of you guys may have this question of, why should you pay off your mortgage in the first place? I mean, that sounds like a silly idea, right? Maybe you have a really low fixed rate mortgage, or you're saying to yourself, well, why not just take any extra money you have or resources and invest it in the markets instead? Why not put it in a mutual fund or an ETF? And of course, another argument I hear all the time is, Sam, why not let the inflation take care of the interest accrual on the mortgage itself? So for the next couple minutes, I'm going to show you why you should pay off your mortgage, especially your primary home residence, and it has to do with something called the two-trap system. So I got my whiteboard here for you guys to show you what is this two-trap system with your mortgage. Let's begin. So what you're looking at is something called an amortization chart. Now, all mortgages, whether it's a 30-year mortgage or a 15-year mortgage, all follow this amortization chart. So the line that goes left to right, this line right here, represents the amount of time you spend in paying off your mortgage. Now, of course, most of you guys have a 30-year mortgage, so this is your first year in your mortgage, and over here is your 30-year mark when it comes to your mortgage. The line that goes up and down represents your monthly payment, specifically your principal and interest payment. Now, for this example, I'm going to use $1,800 for your principal and interest payment because that seems to be the average number for the nationwide P&I payment. Now, speaking of principal and interest, I'm going to draw 2 lines here for you guys. The blue line here that I'm going to draw represents the amount of interest you pay in proportion to your monthly payment on a given period of time. Now, a red line that I'm going to draw here for you guys represents the amount of principal you pay on a monthly basis in a given point of time. So I'm going to label this here again, interest. So as you might notice, in the very beginning, let's say you just got your mortgage today, in your first mortgage payment, the vast majority of your payment is actually going towards interest. In fact, this is true for the most part in your first 5 to 10 years of your mortgage. So if I'm to draw a 10-year mark, which is about right here, you'll notice that most of your monthly payment from year 0 to 10 is going towards interest. Now, us professionals, we call this the front-loaded interest zone. And the reason why we call it front-loaded is because really the vast majority of the interest you'll pay, period, in a span of 30 years, most of the interest is paid up front in the first 5 to 10 years. In other words, really in the first 5 to 10 years, you're not really paying much of your mortgage down. Your payments are not contributing as much to the principal as you might think. So here's where the two-trap system comes into play. Let's go back to that 10-year mark once again. So this is your 10-year mark. So here's where the interesting dilemma is as far as the two-trap system. If we go back to that 10-year mark that I draw on the chart, according to the U.S. Census Bureau data, and you can fact check this with me if you want, the average U.S. adult moves 11.7 times in their lifetime. Now, if you extrapolate that data and say you live to be about 80 years old, do the math. That means that every 5 to 7 years on average, you're going to be moving to a new home. So let's go and draw that line here. I'm going to actually erase the 10-year mark. And let's draw a line to about 6, 7 years. So we'll draw the line about right here. So let's just say that is our 7-year mark. Okay? So let's draw the picture. You bought a house and you live there for about 7 years. You decide to move because of several reasons. Maybe it's a job relocation. Maybe it has to do with job relocation. Maybe you have to increase your size of a home because maybe you have more kids than you thought. Maybe you don't like the state you live in, so you decide to move to another state. I mean, there's so many different factors that could contribute to why you'll likely want to move. I think you guys can all agree with me saying that people are way more mobile than ever before in the history of the United States. No longer are there days where you work for a company for 40, 50 years, retire on the pension, and you're taken care of by the company, right? Even for yourself, you may have noticed that you switched jobs multiple times, maybe you switched a career or two, maybe you know friends and families that moved quite a bit in the last 5 to 10 years. So here's where the dilemma is. You get to the 7-year mark, well, guess what happened? Well, most of your mortgage payment, specifically your P&I, most of it has been going towards interest. And very little of your monthly payment has actually been used to pay down the principal balance. So what ends up happening is that you list your house, put it on the market, and you end up buying a new house. And with this new house comes with the new mortgage. The question for all of y'all is, do you get to continue the progress you've been making where you're getting closer to the principal payoff zone, or do you have to start all over again? And if you're saying you have to start all over again, you're absolutely right. Instead of being able to continue the progress you've been making for the last 7 years, you have to start over all the way back to square zero or square one, where vast majority of your P&I, your monthly payment, is going back towards the front-loaded interest. And the bank's got ya, right? And this is one of the reasons why banks can keep the interest rate so low, because they know in about 6 to 7 years, you're gonna be a customer again. And what business like a bank doesn't want a repeat customer? Now, like the scenario of you moving and having to get a brand new mortgage, there's a second trap to this. You guys wanna guess what it is? Well, it has to do with refinance. So let's say you, again, same scenario, you've been living in this house for 6, 7 years, and all of a sudden the interest rate starts to drop, and the mortgage brokers and lenders across the country are like, oh my gosh, Mr. Johnson, please come on in, let's get you refinanced, let's go and take this $1,800 payment, and let's save you some money and bring it down to, let's say $1,700, therefore you're saving about $100 a month. And that's usually how they pitch you the refinance. But little did you know, as a homeowner, if you choose to take that deal and get a brand new 30-year mortgage, a refinance mortgage, like getting a brand new mortgage with selling your house, you have to start all over back to square one, where sure, you have a lower monthly payment, but guess what? You're starting all over from a place where you have to do all of this front-loaded interest payment all over again. And you're stuck. And you've further delayed you being able to pay off your mortgage, and you really haven't been able to contribute towards paying down the principal. And that's the problem. So what ends up happening is that this cycle of either refinancing or buying a new home will repeat over and over again, to which at point you get to 40, 50, 60 years old, you still have 20, 25 years left to go. And it's really sad because many of our clients are in this situation where they're in 40, 50, 60 years old. They still have 20, 25, 30 years left to go on their mortgage. And we do the math, they're not going to be done until they're 85 or 70 years old, which many of them have to work longer. They have to delay their retirement. That means missing out on your golden years of seeing your kids and children grow, or maybe just even enjoying it yourself by traveling or doing the things that you want to do outside of just working for the rest of your life. And I don't mean this in any negative connotation, but I definitely want to help you not have to keep on working for the rest of your life, or having to delay your retirement, or having to be downgraded and letting young kids take your job, and you're basically relegated to a lower position. I don't want that for you guys. I want you to enjoy your freedom. I want you to go and grow your investments and bolster up your retirement so that you don't have to have those types of scenarios happen to you. So even if you think you have a really low, innocent fixed rate, or maybe you're thinking, you know what, why not just invest in the markets, right? Well, definitely consider the two-trap system, because again, you may have a 3%, 4% really low fixed rate right now, but by the time you move in 5 or 7 years, you may end up with a higher rate, and obviously you're having to pay more at that point. And all the while, you really haven't contributed much towards paying down your mortgage. So again, what may seem like a really innocent 3 or 4 or 5% interest rate, you may find yourself by having 3, 4, 5 different mortgages, you really paid a really, really high rate. Also, another quick fact is that if you have a 5% interest rate on a, let's say, a $100,000 mortgage, you're actually gonna end up paying close to $100,000 of interest, meaning you're gonna pay $100,000 of a loan and $100,000 of interest, which totals up to be about $200,000. And if you don't believe me, definitely check the math on the amortization calculator. So now you might be saying, Sam, what is the solution then? How do we get ourselves out of this trap? I want to pay off my mortgage faster and just get this thing off my shoulders so that I can focus on my investments, my retirement goals, to be able to spend more time with the family, and to not have to keep on working past my retirement age. what is the solution? So let's go and shift gears and show you what is exactly the solution for this strategy. All right, so let's come back to our trusty whiteboard here, and we're gonna go and introduce a new banking product, or it might be new to you guys, maybe you already know, but this is something called a home equity line of credit, oftentimes abbreviated as a HELOC. Now, for this strategy to work, technically you don't even need a HELOC. Many of my clients do, but there is a way of doing this strategy very successfully, saving a ton of money and time without even having a HELOC. Now, what is a HELOC? Well, a HELOC is kind of like a credit card that's attached to your home. It uses your home equity as a collateral to offer you a line of credit. Now, the reason why this is different than your traditional mortgage, and the analogy I like to use is your mortgage is kind of like a horse, right? Does it get you to places? Sure, right? But is it gonna take a long time? Yes. Whereas a HELOC, when used in proper way, like our strategy, it's like a 2024 Lamborghini, right? If such thing exists. So the main difference is, here's your mortgage. So I'm gonna go ahead and give you guys a little comparison. Mortgage, okay, versus a HELOC. Now, a mortgage versus a HELOC, they're just banking tools. It's all about how you use it, right? It's kind of like a drill in the hands of an amateur is completely different than a drill on the hands of a professional contractor. Different results. So with the HELOC, the main thing you need to know is it's revolving, meaning that you can borrow from the HELOC, pay it back, borrow again, pay it back, just like a credit card. Whereas a mortgage, it's closed-ended, meaning that once you make your mortgage payment, particularly a principal payment, you can't get that money back out unless you do what? A cash out refinance, right? Which takes time, there's application, all that. So mortgage is closed-ended, HELOC is revolving. The other differentiator in the context of our strategy specifically is that a mortgage is monthly amortized interest, whereas a HELOC is daily average interest. And I'll show you why this is super important with the two factors, closed-ended, monthly amortized interest, and revolving daily average interest. I'm gonna show you why that's super important for our strategy. I know this is all math, but again, this is why it works. It's math, not magic, okay? Now, I'm gonna show you how the average daily balance and average daily interest works real quick, and this is really important. So let's just say that in your line of credit, a HELOC, you have a $100,000 balance, okay? This is the balance for today, very specifically today, and let's say you have an interest rate of 6%. Now, this alone will give you the interest for the entire year, which is $6,000. But with average daily interest, and how this is so important to our strategy, the interest is very sensitive at the daily level. So what we're gonna do is take that 6% divided by 365. So I got my calculator, and what we're gonna do is we're gonna take that 6%, which is 0.06, divided by 365, because that's the amount of days we have in a year. And that's 0.000164, and it goes on, right? I'm gonna multiply that number by this daily balance of $100,000, and what that gives me is $16.43 for the interest. Now, what that means is that today, where the balance is at $100,000, the interest we're gonna pay is $16.43 for today. Now, here's where it gets interesting. Let's suppose that tomorrow, for some reason, and I'll tell you what that reason is, this balance goes down to $95,000 for the daily balance. Interest rate stays the same because the interest rate does not change, okay? Times 6% divided by 365 days. What that gives us is a new interest amount of $15.61. Now, the point that I want to demonstrate here is that today, let's say we have $100,000 in our HELOC balance. Same interest rate gives us $16.43. Tomorrow rolls around, let's say our balance goes down to $95,000, same interest rate, but we're paying less of an interest tomorrow. So what's happening is that each day is an opportunity for different amount of interest we pay for that daily balance. So here's the ultimate question for you guys. And for my auditory learners, this will make sense. For my visual learners, I'll show you this in a chart in one sec. So what if we can take the entirety of our paycheck, all of our income, and instead of depositing into a checking account, which the checking account isn't giving us any money, instead, we put it in a HELOC or a line of credit, reduce the daily balance to where we're gonna pay less interest, but we still have access to the money because the line of credit allows us to make withdrawals at any given point in time. So here's what I mean. So let's say this is day one, all right? So this is today, day two. So you can start to see the reason why the balance went from $100,000 to $95,000 is to demonstrate that we're going to take, let's say, $5,000 of your paycheck, let's say this is our biweekly paycheck we receive, and make a principal payment, i.e. a deposit, into the line of credit, which lowers the daily balance, which subsequently lowers our interest that we pay for that day. But let's suppose also we keep this $15.61 amount instead of a higher amount of $16.43. Suppose we keep that for a very long period of time, for let's say, 20 days, right? That means instead of paying $16.43 for 21 days, we're going to pay this amount, $15.61, for 20 days instead of paying $16.43. Does that make sense? And again, when you need the money back out, let's say day 22, fast forward to day 22, let's say we need to take $3,000 out for groceries, gas, food, right? Whatever you need to take care of yourself. And this goes back up to, let's say, $98,000. Only then are we going to be paying a slightly higher daily interest. And let's do that math real quick. We're going to pay a slightly higher $16.10 for that specific day. But what we're counting on the fact is, again, every biweekly or monthly, how frequently you get paid, we're going to go and deposit all of our income into the line of credit balance so that we can keep the average daily balance really low, which subsequently means that we pay less interest every day, but we have the ability to take that money out whenever we need to for groceries, gas, emergencies, rainy days, etc. So in a minute, I'm going to show you what this looks like mechanically, what this looks like from a high level. I'll show you that in just one sec. So right now, I'm going to show you guys two main versions of this strategy. In fact, there's 7 or 8 different versions of the strategy you can use. Again, you don't have to have a HELOC. I know some of you might be thinking, oh my gosh, HELOC sounds really dangerous. What if the HELOC shuts down, or what if it gets frozen? Like, aren't HELOC rates variable and they're high? I'll address those questions in just one sec. Bear with me here, but I'll show you 2 of the different versions of the strategy that could work. And again, you don't need to have a HELOC for this strategy. There's other ways of doing it. But the first scenario I'm going to show you is something called a first lien scenario. Now, a first lien scenario, let's say we have a mortgage here, and let's keep it simple. Let's say $100,000. And in a first lien scenario, what's happening is that we're going to get something called a first lien position home equity line of credit. What that means is that, let's say we have our HELOC here, is we're going to actually completely pay off our mortgage, where technically this is considered a refinance, but we're basically going from a horse to a 2024 Lamborghini, right? The analogy I gave you guys earlier, you guys remember that? So we're going to go and completely replace our mortgage, where now all the balance that we had in the mortgage, we're going to transfer it over to our HELOC, whereby now the only debt that we have on our home is the HELOC. Now, some of you guys are saying, well, hold on, how did you get a HELOC that large when you still owe $100,000? Now remember, this is a first lien HELOC. What most of you guys are probably thinking is a second lien HELOC, and I'll show you the difference. But with the first lien HELOC, a lot of the first lien HELOCs will go up to 80 to 90% loan to value, meaning if your home is worth $100,000, you can get a HELOC up to $90,000 to completely replace your mortgage. So again, the first lien HELOC is all about replacing the mortgage. The only debt that you have on your home is a HELOC. Yes, there are banks that will let you do that. We're not going to get into that topic today, but just know that this exists, and we'll show you what it looks like on a second lien. Okay, so now once the mortgage is out of the picture, the only debt we have is a HELOC. Just like what I suggested earlier, we're going to go and take all of our income and make a deposit against the HELOC of, let's say, $5,000 to keep it consistent. And therefore, now we have a $95,000 HELOC balance, which again, you guys seen what that does to the interest that we pay on a daily basis. From there, we're going to go ahead and utilize, we're still going to have a checking account, but only as kind of like a gateway, where we're going to use that checking account to pay for our expenses, gas, groceries, you name it. In fact, how most of our clients have set this up to where most of my clients, what they do is, I know having a separate HELOC and a checking account, that may seem messy, but really what most of my clients do is they have a HELOC and a checking account with the same bank. They set up auto draft as well as overdraft protection, which means that if you spend money out of the checking account where there's zero money in the checking account, it'll automatically draw from the HELOC to cover whatever expenses, which is pretty cool. It's kind of like autopilot, right? So by doing it this way, pretty much treating your HELOC like a checking account, taking all of your income, right, and putting it in the HELOC, this allows you to lower the average daily balance, saves you money on the daily interest that you pay, which goes a long way, still allows you to go spend money on gas, food, groceries, expenses, etc., even pay for credit card bills, auto loan bills, whatever the case might be. This is the scenario. So again, this is the first lien HELOC scenario where the HELOC is completely replacing your mortgage. You're still using a checking account. Now, I'm gonna give you a little bonus tip, and I don't share this unless you're a client, but I'm gonna do it anyways because I love you guys, right? So here it is. On top of a checking account, because we want to delay ever having to take money out of the HELOC, right? That's balance and time is the enemy. Instead, what we're gonna do is we're gonna introduce a credit card, preferably ones that gives you cashback bonuses or points for travel, whatever the case might be. Instead of doing your expenses directly out of the checking account or through a debit card, you're gonna do it through credit cards. And obviously this gives you points and cash back, right? And of course, what's special about credit cards is that they have grace periods where you could do all your expenses, right? Charges at the stores, grocery stores, and interest is not due until the next statement or billing period, right? So what that allows us to do is pay zero interest. So what that allows us to do is pay zero interest on the credit card and minimize and keep this balance low for a long period of time, right? For 21 to 28 days preferably. And we get points and cash back rewards. Then what we're gonna do is we're gonna completely pay off the credit card to zero and make a draw out of the HELOC to pay off the credit cards, subsequently paying no interest at all. Does that make sense to you guys? You guys getting this? Again, part of what I do is I set all this up for our clients, keep it autopilot, make it really simple so that really there's not much discipline that they need to do. We have software and apps and tracking systems that our clients use to be able to track everything on autopilot, which is awesome. So again, we'll get to that kind of stuff later. But for now, let me show you what it looks like on a second lien HELOC scenario. So let me go and show you what that looks like. So back to our whiteboard. Let's say we have same scenario, mortgage. Let's say $100,000, and let's say we have a HELOC here. Now, instead of, unlike the first lien HELOC where we're completely replacing the mortgage, what we're doing is we're getting a second lien HELOC. So we're not gonna mess with the mortgage. We're gonna leave the mortgage alone. We're gonna get a separate HELOC where the mortgage is in the first lien. So this is a first lien mortgage, and this is a second lien HELOC. So you have a mortgage, and then you have a HELOC on top of that, right? So let's assume our property value is $150,000, fair market value, FMV, and we owe $100,000. Now, most second lien HELOCs, you can get 80 to 90% loan to value. The most we're gonna get, and I've done the math for you guys, is a $35,000 limit on our second lien HELOC, right? So you combine the $100,000 mortgage and $35,000, that's $135,000, which is 90% combined loan to value against the $150,000 fair market value home. And in this scenario, what we're not doing is we're not gonna replace the entire mortgage, but we're gonna take small chunks. And in this example, let's go with, let's say $15,000 chunks. So what we're doing is we're doing a $15,000 principal payment against the mortgage balance, where now this will drop to $85,000 balance, and here we have a $15,000 HELOC balance. So now by doing that $15,000 principal payment against the mortgage, a couple things happen. One, yes, you're saving a ton of interest on the mortgage side exclusively. What you're doing is you've accelerated the payment. You'll notice in an amortization chart or amortization table, it's gonna look like as if you skipped a lot of payments on that mortgage, which you didn't. But in essence, what that's gonna do is it's gonna go and save you money on the interest, but also you sped up the time in terms of the timeline for paying down the mortgage. Now, of course, a lot of you guys are saying, Sam, come on. I mean, yes, we paid on the mortgage, but we still have a $15,000 balance on our HELOC. What do we do with that? Well, just like the first lien example, we're gonna take all of our income and paycheck, make a deposit, let's just say $5,000, okay? Therefore, this is chopped to $10,000, which guess what? Means lower daily interest, less interest we pay overall, and we're gonna use the HELOC, second lien HELOC, just like the example I showed you earlier. We got the checking account here, and we're gonna go and use that checking account for our expenses. And of course, the bonus material I gave you guys is using also a credit card to be able to purchase all the gas, food, groceries, and all that, and use the second lien HELOC to pay off the credit card every month because we don't want to pay interest on the credit card, right? And ultimately get points and cashbacks out of the credit card, which is also a phenomenal way of doing this strategy. So what's going to happen with this scenario is that eventually you're going to get to a point where you're going to go in and completely pay off the HELOC with the positive cash flow we have, the savings that we have on the HELOC. And once it hits zero, you're going to do another $15,000 principal payment against the mortgage, the first lien mortgage, which obviously saves you more money. Now, all along, you still have to make the mortgage payment. And I know some of you guys are saying, "What? Hold on, Sam. Doesn't that mean that we have our first lien mortgage payment and a second lien payment? Didn't we just create a second payment for ourselves?" Well, not exactly, because the income that's going into your HELOC counts as a payment, right? It's factoring the interest as well. So technically, you don't have a second payment because your income going in there is a payment. It counts as a payment according to the banks. So obviously, you've been making payments on that first lien mortgage. So this balance should actually be down, right? Because it takes time for that $15,000 HELOC balance to go to zero. So by then, you should have seen a decrease even on your first lien mortgage payment as well. So another $15,000 principal payment reduces this down even further to, let's say, $70,000. You have another $15,000 balance. You're going to take all of your income to pay it down. You're going to use the credit card to do all your expenses, pay it off at the end of each statement period. Therefore, you're not paying any interest on the credit card, and you're maximizing and elongating the fact that your second lien HELOC balance is staying low. Let me reiterate the fact that you don't need a HELOC for this strategy. In fact, there are other ways of using a 401k, a personal line of credit. We actually have something called a hybrid self-funding method, which, again, we don't have time for that in this video. But I'm just showing you two main tools that my clients use to save thousands of dollars and years of time when it comes to the mortgage. Now, let's get to some of the questions that you guys may have about this strategy and some of the concerns that you may have. Now, right out of the gate, I know I'm just a guy on the internet, on YouTube, and you may not trust me yet. That's totally good. You probably shouldn't trust everybody on the internet. So check this out. My company is called Accelerate Banking, and this is our BBB review. I'm gonna put it on the screen for you guys, of course, at the time of recording this video. And here's another one from Trustpilot, which also were rated excellent on Trustpilot as well. These are two independent rating sites. You guys can check it out. I'll put the link down below. But I show you this not to show off, but show you that what we've been doing for the last 8 years, we have some credibility. Now, one of the main concerns that we get all the time is, Sam, I have a really low fixed rate mortgage, 2.5%, 3%, 4%. Yet here you are telling me that I need to get a HELOC with a strategy, potentially with 6, 7, 8, or 9% interest rate, and they're variable. It doesn't make any sense. Like, how does that even work with this strategy? Am I still gonna be able to save money? Well, check this out. I'm gonna show you a calculation. I'm gonna put it on the screen. And in fact, this calculator that we built, we're gonna give this to you guys as a special gift, but wait until the end. I'm gonna show you how to get it. But this calculator shows that, you can see it on the screen, that even with a low interest rate of, let's say with 3% rate on your mortgage, and let's just say we're gonna use an 8% second lien position HELOC, you'll notice with the result, you're still saving a lot of money. Again, guys, the enemy is not the rate. The enemy is time and balance. You give a loan enough time and the balance, no matter what the interest rate is, it's gonna cook up a lot of interest amount, period. In fact, here's a screenshot of one of our clients. Her name is Deborah, and you'll notice that all of her mortgages are at 4% or lower, some even at 0, but even using a 5% HELOC, she's still able to save a ton of money, even better than doing extra payments. And when I say extra payment, I mean taking any extra money you have, a couple $100 here and there, or tax returns, throwing that into your mortgage. And that leads to the next question that you may have. Why is this better than paying extra into the existing mortgage? Sam, why not just take extra couple $100 or make bi-weekly payments to my mortgage? Why is this strategy better than that? Well, with those types of scenario where you're doing extra payments to your mortgage or bi-weekly payments, you're just using your extra cash flow to affect the balance on the mortgage. Where our strategy, the entire income or your savings is being used to affect the average daily interest on the line of credit, which means that you're using the same amount of dollars that you have to do more of the work than you think. Plus, leaving your money in a savings account or a checking account pays you very little, right? I mean, most interest rates on a savings account is really, really low unless you get a CD, which, again, the problem with CD is that you can't take that money out whenever you want to, right? So instead of losing your money on inflation at 0% checking account, why not leverage your dollars in cash flow to lower the average daily balance on the line of credit and save money, but still give you the access to money whenever you need it. Now, one of the last concerns that we get quite a bit is, Sam, I heard these HELOCs got shut down and frozen back in 2008 through 2012, totally unexpectedly, and caught a lot of people off guard. What if that same thing happens? Well, yes, 2008 through 2012, we did see a lot of HELOCs get shut down or frozen because of the Great Recession and the financial impact it had on many homeowners, right? We saw a lot of foreclosures happening. Now, here's the good news. From a legal standpoint, in 2012, a new law was passed called Dodd-Frank Act, which protects homeowners and consumers and lenders, and there's new rules that are created to protect homeowners from that. One example is that if a bank wants to freeze your HELOC or shut it down, they have to give you a 60-day notice with an intent to do so, which means that you have 60 days to go get another HELOC or use another tool that we have in the Accelerate Banking Suite. And another thing is that no longer are there days where banks are giving out 110, 120% loan-to-value loans, where a lot of the risk is already mitigated by the regulation itself. And I'll give you an anecdotal example. Over the last 8 years of serving over 2,000 plus clients, I've yet to lose a single client because they've lost their HELOC or had their HELOC shut down, frozen. Again, you don't have to have a HELOC for this strategy to be successful, but if you are, that kind of tells you that the odds of a HELOC getting shut down is very, very low, even through the COVID-19 pandemic. So I know some of you guys are still going to have questions about this strategy, maybe doubts or concerns. You want it to work, you want to believe that this is true, and you're thinking, man, this still sounds too good to be true. Well, I want to give you a free personalized gift, and one of them is a free calculator. So the calculator that I showed you earlier a few minutes ago, I want to give it to you guys absolutely free. So you go to chopmymortgage.com, and I'll go and put the link down below in the video description as well. You're going to get the opportunity to download the calculator. Now, another thing I want to add to this, and I forgot to mention, is that our strategy not only applies to a mortgage, but it could apply to all the other debt that you have. So credit cards, student loans, furniture loans, solar loans, construction loans, whatever the case might be, our strategy can still be used for other types of loans. Maybe you have a mortgage and consumer loans. We'll actually be able to help you pay off both of them in as early as 5 to 7 years. So go to chopmymortgage.com. The link is down below. The second gift we're going to give you is that after you download the calculator at chopmymortgage.com, we're also going to give you the ability and opportunity for a free 45-minute consultation session where you can learn more about the strategy, ask any questions that you may have. Maybe you have a very specific situation. And what we'll also do is we'll give you a free estimate as well as a complimentary report as to how much time and money you'll expect to save using this strategy. And of course, we'll make an invitation to join us as clients. So you guys can go definitely check out the calculator. Now, I want you guys to make well-informed information. I don't want to put you in harm's way. So definitely go and check out the calculator, schedule a call to see if you're a good fit, if this even makes sense to you. Should you and could you do this strategy? That's really important. We also recognize that not all of you guys should do this strategy. Maybe you have a completely different goal. For those that want to get into real estate investing, this is going to be really good to be able to help you access to equity so that you can go and buy some more rentals and stuff like that. Again, not everyone should be doing this strategy. Let me preface that. But I truly believe that if you are a good fit, not doing this strategy is going to cost you a lot of money. I said it earlier, I don't want you guys to continue working beyond your retirement age where you're 60 or 70 years old and you still have 30 years left to go on the mortgage. Like, you guys have no idea how many clients that I have that are 50, 60, and 70 years old and they still have 20, 30 years left to go. And unfortunately, their mortgage is going to outlast them, and that's not the scenario that I want to see. I want you guys to enjoy the freedom of time, freedom of money, freedom of purpose and relationship. I'm personally a Christian. I believe that Jesus Christ is Lord and Savior, and I want you guys to truly live in your calling and the purpose that you guys have, and that's what I'm all about. So with that being said, go to chopmymortgage.com, get your calculator. It's free. It's completely free. You guys can download, and then afterwards, we invite you to a free 45-minute consultation session where we want to give you personalized help. So that being said, guys, thank you so much. I hope you enjoyed this video. I hope this opened your eyes at least to some of the problems that you weren't really aware. And if you just have that inkling of, gosh, I really need to be able to pay off my mortgage. I want to get that out of the way. I want to get this weight and this burden off my shoulder that I call a mortgage and my debt. Guys, go check it out. We'd love to help you out. So that being said, I love you guys. Appreciate you. And God bless. We'll see you in the next video.